Right now, Pfizer, ticker PFE, is trading at $24.32. That's a drop of 39 cents or 1.60% on the day. And this, right here, is one of the most telling and most painful stories on the market today. Because to the casual observer, this drop makes no sense. This morning, Pfizer reported its third quarter 2025 earnings, and it beat expectations on profit. The company posted an adjusted earnings per share of 87 cents, which was substantially better than the 66 cents analysts were looking for. Not only that, they raised their profit guidance for the entire year. A company beats on earnings, raises its outlook, and the stock falls. This, right here, is one of the market in real time screaming at you that it does not care about Pfizer's cost-cutting. This 1.60% drop isn't just noise, it's a profound vote of no confidence. The expectation was that at this beaten-down price, any good news would spark a relief rally. The reality is that the market is completely and totally focused on one thing: a top-line revenue number that is still shrinking, and no amount of financial engineering can hide that. The common belief, the one that has so many investors on their Robinhood app or their SoFi Invest account looking at this stock, is that it's the ultimate value play. The company that literally saved the world with the COVID-19 vaccine is now trading at a rock-bottom price. It has a price-to-earnings ratio of around 7, a PE of 7? For context, a company like Apple stock trades at a multiple of 30, and a high flyer like Nvidia stock is in a different universe. On top of that, Pfizer is paying a massive dividend, yielding close to 7%. The story writes itself. Buy this safe, blue-chip stock, lock in that massive dividend, and wait for the market to come to its senses. It's the kind of logic that seems perfect for a set-it-and-forget-it Fidelity IRA. The expectation is that this is a coiled spring, a safe haven in a volatile market. But that expectation is a trap. It is a classic, textbook value trap, and today's 1.60% drop in the face of an earnings beat is the proof. The market is not stupid. It's looking right through that adjusted EPS number and at the source of the problem: revenue. Total revenue for the quarter was $16.65 billion. That was a miss against expectations, and, more importantly, it was down 5.9% from the same period last year. Why? Because the COVID-19 revenue cliff is not a cliff, it's a bottomless chasm. Sales of their COVID treatment, Paxlovid, collapsed by 55%. Sales of the Comirnaty vaccine fell 20%. This is the COVID hangover that the bulls have been underestimating for 2 years. This is billions upon billions of dollars in high-margin revenue that has evaporated, gone forever. What Pfizer's management did this quarter was prove that they are very good at one thing: cutting costs. They beat their profit target by slashing their spending, but they did not solve their growth problem. The market sees this as a low-quality, hollow victory. It's like celebrating that you're saving more money because your salary just got cut in half. Now, the bulls will point to the non-COVID part of the business, and to be fair, it's doing well. The company's blood clot medication, Eliquis, saw sales jump an impressive 22% to over $2 billion. That's a fantastic number. But it's not enough. The growth in their legacy portfolio is like trying to fill a swimming pool with a garden hose while a drain pipe the size of a manhole is wide open at the other end. The COVID revenue is being suctioned out faster than their other drugs can possibly replace it. This is why a sophisticated Schwab Intelligent Portfolios algorithm would likely flag this stock as a high-risk value trap, not a high-quality value holding. The market wants growth, and Pfizer just showed, once again, that it doesn't have it. This isn't a growth story like Tesla stock, where you're debating delivery numbers. This is a story of managing a painful structural decline. And here is the truly terrifying part. Even if you, as an investor, could magically forget the entire COVID boom and bust cycle, even if you just wanted to value Pfizer on its core non-COVID business, the real bear case is just getting started. What the professional investors, the ones using interactive brokers to model complex financial scenarios, are focused on the next cliff, the patent cliff. Between 2026 and 2028, Pfizer is facing a wave of patent expirations on its biggest remaining drugs. We're talking about Eliquis, the very drug that just posted a 22% gain. We're talking about the cancer drug Ibrance. We're talking about the Prevnar vaccine family. This is estimated to be an $18 to $18 billion hole in annual revenue that will open up in just over a year. So this company is fighting a two-front war. It's desperately trying to plug the COVID-sized hole in its boat right now, all while knowing that a second, even larger torpedo is already in the water and set to hit in 2026. This is the context you must have to understand management's recent moves. The $43 billion all-cash acquisition of Seagen was not a strategic bolt-on. It was an act of desperation. It was the company taking its entire balance sheet, all the cash it made from the pandemic, and throwing it at the wall in a high-stakes bet-the-company gamble to buy a new oncology pipeline. They are hoping that Seagen's advanced antibody-drug conjugate technology can create a new generation of blockbuster cancer drugs before the patent cliff wipes out their existing portfolio. This is an incredibly high-risk, high-cost strategy. And so far, other attempts to find growth have failed. Just look at their RSV vaccine, Abrasvo. This was supposed to be a major new catalyst, a billion-dollar blockbuster. But it has been consistently and decisively beaten in the market by GSK's rival shot, Arexvy. The entire RSV market has also been smaller than expected after regulators narrowed their recommendations. It's another broken promise, another failed catalyst, which is why the market has zero patience for a beat-and-miss earnings report like the one we got today. This all leads us to the one thing that has value investors hanging on, the dividend, that juicy 7% yield. In its earnings call this morning, management was explicit. They are committed to the dividend. But this is where an investment becomes a game of psychology. Why is the yield 7%? A stock doesn't yield 7% because it's safe. Apple stock doesn't yield 7%. A stable Fidelity ETF tracking the S&P 500 doesn't yield 7%. A stock yields 7% because the market is pricing in a significant, non-zero risk that the dividend will be cut. The payout ratio is getting stretched thin. The company is burning cash on the Seagen integration and paying out billions in dividends, all while its biggest revenue streams are vanishing. A Fidelity Wealth Management advisor would tell you that a company will defend its dividend to the very last breath until it doesn't. A dividend cut would be the final symbolic capitulation, and it would send this stock, currently at $24.32, spiraling into the teens. That is the risk that is baked into this stock. This is a story of two completely different realities. The bull case is that this is the absolute bottom. The COVID cliff is now fully priced in. The Seagen acquisition will be a home run, and its oncology drugs will more than fill the 2027 patent gap. The 7% dividend is safe, and patient investors who buy today will be rewarded handsomely. The bear case, which the market is siding with today, is that this is a classic trap. The company is in a show-me state. And today's report, with its revenue miss and its cost-cut-driven profit beat, was not the show-me moment. The bear case is that the Seagen integration will be too slow, the patent cliff will hit too hard, and the dividend will, in fact, be cut within 24 months. For all the retail investors doing their own self-investing, this is a truly difficult stock to analyze. This is the ultimate question for this company, the one that divides the entire market. Comment below, do you trust Pfizer's management when they say the 7% dividend is safe? Or do you think a cut is inevitable to fund the Seagen pipeline? Let me know what you think. As Pfizer sits here at $24.32, down 1.60% after what looked like good news, we are watching the market reject a company's entire narrative. The expectation is that you're buying a safe, cheap, high-yield blue chip. The reality is that you are buying a company in a desperate, high-stakes transition. It's fighting to survive a post-pandemic collapse while staring down the barrel of a massive patent cliff. And it just bet its entire future on a $43 billion acquisition. Today's drop is the market telling you, in no uncertain terms, that it does not believe the turnaround is working. Disclaimer: this content is for informational purposes only.